This video is intended for educational and informational purposes only and does not constitute tax, legal, or financial advice.
Hello. Today, I'd like to talk about a tax issue that confuses many people. The taxation of insurance proceeds. When people receive insurance money, most assume I probably don't have to pay taxes on this. But in reality, the tax rules vary depending on the type of insurance, the purpose of the payment, and whether the property is personal or business related. We'll go over three main categories. First, life insurance proceeds. Second, insurance payments related to personal property. And finally, insurance proceeds connected to business property. At the end, I'll also share some strategies you can use to reduce taxes. Let's start with life insurance. This one is the most straightforward. When a policyholder passes away and the beneficiary receives a lump sum death benefit, that amount is generally not taxable. You don't even need to report it on your tax return. However, if the insurance company holds onto the payout for a while and interest accrues, that interest is taxable income. If the beneficiary chooses to receive the payout in installments, similar to an annuity, the portion that represents the original principal is not taxable, but the interest portion is taxable. And one more thing, if the insured owned the policy at death, or if the estate is named as the beneficiary, then the proceeds may become subject to estate tax. Next, let's talk about insurance proceeds from personal property, such as your home, car, or household belongings. The general rule is that if you use the insurance money to restore or repair the property, it is not taxable. The purpose of insurance is to make you whole again, not to give you a profit. So if you simply return to the condition you were in before the loss, that's not considered taxable income. But if the payout exceeds your adjusted basis in the property, the excess is considered a capital gain. For example, if you had a car that was fully depreciated, meaning its basis was zero, and you received $10,000 in insurance proceeds after an accident, that entire amount is treated as capital gain. In these cases, you may defer the tax by applying the involuntary conversion rules under Section 1033 of the Internal Revenue Code. If you reinvest the proceeds in similar property within the allowed time, usually 2 to 4 years, you can postpone the tax. Now, let's look at additional living expenses, often called AE. If your primary residence is damaged and you need to live elsewhere, temporarily, insurance may reimburse you for the extra costs of housing and meals. These payments are generally not taxable, but if you receive more than your actual additional costs, the excess is taxable. What about casualty loss deductions? Traditionally, if your insurance reimbursement was less than the actual loss, you could deduct the difference. But since the 2018 tax law changes personal casualty loss, deductions are only allowed if the damage occurred in a federally declared disaster area. On top of that, there's a $100 reduction per event and a 10% of AGI threshold, which makes it harder to benefit from small losses. The recent One Big Beautiful Bill Act, however, expanded relief. For qualified disaster losses, the 10% AGI limitation no longer applies. The $100 reduction is increased to $500, and you can still claim the deduction even if you take the standard deduction. Now let's move to business property. This area is more complex than personal property. The general rule is similar. Insurance proceeds used for restoring or repairing business property are not taxable. But if the insurance exceeds the property's basis, that excess is a taxable capital gain. Again, Section 1033 can be used to defer tax. If you reinvest in similar property within the allowed period, usually 2 or 3 years, and in some cases 4 years for real estate, business interruption insurance is different. These payments replace lost profits or business income, so they are taxable. The good news is that expenses paid with those funds, such as payroll, rent, or utilities, can still be deducted. As for deductions, there are 2 main ways to handle business property losses. If the costs are simply for repair or maintenance and don't improve the property, you can deduct them immediately under Section 162. But if the loss is not reimbursed, you may claim a casualty loss deduction under Section 165. You can't double dip, though only one method can be used for the same loss. Small businesses may also qualify for safe harbor rules, which simplify the decision and may avoid capitalization requirements. Finally, let's talk about strategies to reduce your tax burden. First, think about how your settlement is structured. The way insurance proceeds, or legal settlements are allocated across different categories matters. Allocating amounts to non-taxable categories, like physical injury, compensation or property restoration, can save taxes. Second, consider receiving payments in installments rather than a lump sum. A large one-time payment could push you into a higher tax bracket, while spreading it out may keep you in a lower bracket and reduce your overall tax. So to wrap up, life insurance proceeds are generally tax-free, but interest and estate tax issues may apply. Personal property insurance is usually tax-free if it only restores your loss, but excess payments can be capital gain, and special disaster rules now apply under OBBA. Business property insurance follows similar principles, but business interruption payments are taxable, and Sections 1033, 162, and 165 provide important tax planning options. The bottom line is that the tax rules for insurance proceeds are detailed and sometimes tricky. Small differences in how the proceeds are handled can lead to very different tax results. That's why it's always wise to consult with a tax professional when you're dealing with significant insurance payments. Thank you for listening, and I'll see you in the next video.